For those of you who watch Bloomberg TV, CNBC, and or Fox Business News, you're sure to recognize my next guest as one of the more prolific faces and names in the industry. He's also a regular contributor to Yahoo Finance, Barron's, and he's also the chief strategist of Interactive Brokers, Mr. Steve Sosnick. Steve, great to see you again. Thank you so much for joining me.
Great to see you as always, Mark.
Steve, let me ask you, yesterday you were a panelist on one of the inaugural sessions of OIC conference here. One of the discussions that was had centered around the potential listing of daily expirations for single stocks. But you had some reservations about that. Can you tell me what those are? What are your thoughts on those daily expirations for single stocks?
Sure. First of all, I consider it a great honor to be on one of the earlier panels. You know, I got that honor last year, so thanks to everyone at OIC who made that happen. That's to me, that's a real testament to what I just love the idea that I get to participate in that.
And, well, thank you. I'll certainly pass along the well wishes. Thank you.
So, what happened was, NASDAQ basically filed shortly before the conference, and honestly, I think they did that intentionally, knowing that this would be the talk of the conference, and that's they knew that the whole industry would be here. That they were going to be filing for individual stocks expiring on Mondays and Wednesdays, and they're doing it so that they don't coincide with posted earning dates. Now, that is sort of the way that the zero DTE movement started with index and major ETFs. It was in 2016, I believe, that they listed Monday and Wednesday expirations. Then in 2022, they filled in the Tuesdays and Thursdays.
Right.
So this is the next logical step.
It's the trend
in having daily expirations. I prefer to call them daily expirations because to me, and I used the term yesterday, the compression of the expiration cycles.
I like that.
Having gone from quarterly as an industry, quarterly, monthly, weekly, sub-weekly, and then daily. So, that's really the way it goes. And so this is everybody sort of knew this was going to happen. It was one of these things that was looming out there. Someone had to move first, and I give NASDAQ credit for doing it. Because really they're going to be the ones doing the heavy lifting, because realistically once NASDAQ gets approval to list those strikes, that everybody OCC publishes them, and then everybody starts trading them. So they're the ones they put themselves out there, and I give them props for sticking their neck out.
Yeah.
My reservation is not so much in the trading. I was never one of the people who was saying, "Oh, zero DTE, that's going to be Volmageddon." No, it's not, because there's really nothing new about any of these listed options as a product. We've been evolving as an industry for over 50 years. There's nothing fundamentally different about them. The industry's risk management and risk tolerances have evolved as the products have evolved. OCC, of course, has been a key factor in that. But there's a specific issue that I see with the single stock daily expirations that don't exist currently. And this is, the devil's always in these differences. And what happens is now a lot of all the professionals realize it, but a lot of individuals don't, that you can always submit contrary exercise expressions.
Right. And what you mean by that is the option finishes in the money. It's automatically going to be exercised. You're choosing not to exercise even though it's in the money, or conversely, choosing to exercise an option that's out of the money.
Exactly. What I don't think people realize is, because OCC does auto exercising very efficiently, most people don't think about it. You've got your option closes at the end of the day, in the money, out of the money, but the right, but not the obligation, persists until 5:30 Eastern time, 4:30 Central, and that means that if there's movement after the close, one can change his or her opinion on whether you want to exercise or lapse that option that would otherwise be exercised. So OCC will exercise it unless they're told otherwise. The flip side, of course, is if you've written that option, you've foregone that right,
Right.
but in exchange for the premium that you received.
Correct.
But in that hour and a half, there's not much you could do about that if you're short the option.
Right.
And it's become more popular, and I think this is a testament to education. Is that individual customers don't only just buy options. They do spreads. They do other strategies. They write. They collect premium. They do other things that expose them to the short side of the option market.
Mm-hmm.
And I think in general, most customers do it in a relatively risk managed way. And I think brokerage firms in general are pretty good about managing that risk. But the early exercise risk, the early assignment risk really, is one that can't be efficiently managed too well. So again, on a typical Friday, there's not usually a lot of market moving news. On the daily expirations of index options and major ETFs on those indexes, it takes a lot to get them to move.
Mm-hmm.
You need something like the Liberation Day announcements for them to really have substantial moves. The small moves have happened all the time. I mean, when I was market making, we would sit there and if, let's say QQQ closed at, like whatever the strike was, and then it went 10 cents below, I'd buy some, if I was long the Q calls or, calls, I'd buy some if it went below and I'd sell if it went above, and then tailor my exercise instruction accordingly, based on that, my ability to trade those. Those are very minor tweaks, and those, if you sort of land at this point, the industry is pretty good about if you're landing the plane there, and you don't have the capital to meet any assignment that's at the money. Those usually get squared away before the close.
Right.
The problem is, let's say a company has a profit announcement, profit warning, or corporate announcement. Those stocks can move 5-10% sometimes after the close. Though that means they have the potential to go through, especially in a world where you have dollar strike intervals.
They can blow through dozens.
You can blow through a lot of strikes, and that is where you have the problem. Somebody goes home thinking that their position is squared away, and then some news breaks at 5:00, and they wake up in the morning and they find that they're in a bad situation. The other problem you have is different firms have different windows for when you can submit those instructions.
Right.
The OCC cutoff is 5:30 Eastern, but different firms accept contrary exercise instructions up until different times. So you have an uneven playing field there. As a firm that allows them relatively late, maybe that's a good thing for us.
Yes.
But in general, there's a level of risk out there that really can't be taken away here if you allow contrary exercise instructions on these individual names. And I know that NASDAQ is trying to mitigate that by doing their best to avoid earnings dates.
Right.
But earnings dates are not etched in stone. They move.
And it's not the only, financial news that could impact a security.
Absolutely. So I could certainly imagine a scenario, let's say, where NVIDIA options, which would undoubtedly be among the ones that would get listed first, where earnings might come out in AMD or Broadcom that influence NVIDIA in one direction or another. And so so that they might avoid the pitfalls of a Broadcom earnings announcement, but Broadcom earnings might say something that cause NVIDIA to move.
Right. So it may not be the earnings of that particular company, but maybe a company in that sector that affect everything else.
Yeah. Or you could think we can go down this road a million different ways. The CFO
Tariffs.
The CFO resigns.
Yeah.
Something that seems relatively benign, but these announcements tend to come after the market closes, and that's the period of danger. So the suggestion that I have, and let me be very clear that I have not run this by our chairman or CEO, so I'm speaking myself. I've spoken about this with colleagues, but not the people who would be signing the.
So this is your opinion, not that of Interactive Brokers.
Not the people who would be signing. I don't know if it is or is not yet the opinion
Understood.
of the people who would be signing a comment letter.
Or your paycheck.
Or my paycheck. More importantly, my paycheck. My suggestion that I raised yesterday during my talk was, I think that it would be best for the industry if there were no contrary exercises allowed on non-Friday expirations. I guess Thursdays
Right.
when it's a Thursday,
Right.
but on different expiration days. I think that would be very useful. One of the ideas that I'd kicked around was you're making them European style, which effectively means you can't exercise them
Right.
early. But that would require basically two sets of symbols within OCC
Correct.
symbology, and nobody needs that. That's problematic. The other thought would be cash settled, which people love with SPX.
Mm-hmm.
That doesn't really make sense either, because you have a problem also so you have some options that give you delta exposure at the end where the cash settled options don't. So there would be a very imperfect hedge. That's got its own set of problems. This to me would be the way that would get us the closest to it. I don't know if that's this. I don't even know that what I've proposed is even allowed in the industry. But I think that, since this would be a new set of contracts, perhaps the contract can be written, the industry-wide contract can be written in a way to avoid this risk. And then let us all get on with what the industry wants to do, which is trade this stuff.
Yeah, interesting. Let me transition to something. So you were mentioning earlier about the exercise cutoff times and how it varies from firm to firm. To me, that makes it seem that there's an unlevel playing field between not only trading firm to trading firm from a customer's perspective, but from the customer itself. Meaning, if I trade with brokerage A and I've got a 4 p.m. cutoff time, or I trade with brokerage B and I've got a 4:30 p.m. cutoff time, there's going to be a difference. I'm going to be able to take advantage of the news, that after hours news that you're talking about, in a different way than somebody else that has a different trading firm. So,
may I interject one thing here, Mark? Most professionals have access to the full 5:30 time.
Correct.
So in many ways, you have sort of the pros have a better access.
They have the advantage.
The pros have an advantage over the end customers.
Right.
In many
advantage
cases.
of time. So building on that, is it an unlevel playing field? Is it an uneven playing field? Meaning, is it a lot of investors, retail investors, brand new to investing in options, they see all the stuff on social media. It's a rigged game. It's a rigged system. Is it?
No, I don't think it is. But my belief is we should never give even the slightest impression that it could seem like a rigged game.
Right. Yeah.
And so this situation, that's why I'm advocating for this particular methodology, because that would minimize it. Look, to be fair, professionals do have an advantage in many cases over retail. This is what professionals do all day. There's a lot of money. There's a lot of resources. This is their full-time job.
There's a reason that a market maker on the trading floor was paying a $10,000 a month seat lease.
Yes. So there is. So it's never going to be completely level. But I think that it's in the industry's best interest to level the playing field to the extent that it can be leveled. Right. With the understanding that it will never. It just can't. It just can't be. There's always going to be people who are, better than others. I mean, if we were playing basketball, I'd like to think
you and I would be riding the bench.
Yeah, and someone who's 6'6" would have a natural advantage over us. It happens.
Right.
So I do understand that, but I think we should, sort of using the sports analogy, let the differences come via talent and approach, not because of some regulatory glitches that I think are avoidable.
Okay. With the evolution of the industry, now we were talking about single stocks earlier. It's going to require an evolved trading system, right? So Interactive, you guys are certainly at the forefront of technology. How have you seen the implementation of technology over the last several years versus where it was, 20 years ago? What has that evolution looked like?
Well, I mean, we've always liked to think of ourselves as technologically at the forefront of things. Certainly when we were market makers, we were among the first to really embrace the electronification, is that a word?
Yeah. It is now.
It is now of the marketplace, and that's always been in our DNA.
Mm-hmm.
And so I'd like to think that in terms of risk management and technology, it remains always one of our number one concerns, and we're always looking to make that as seamless as possible for our customers and give them that benefit. Now, the one thing that we find here is, I think the fact that that the APIs, the automated ability to trade, really used to be the province of professional investors,
Right.
and that's been democratized a lot. There are third-party API, there are third-party companies that use APIs. Many of them use our API. Thank you to them. There are others that use different setups. In one of the talks, there was some discussion about how AI has made it easier to program some of these APIs.
Yeah.
So I think that this is being, again, in terms of leveling the playing field, the individual investor in many cases is getting access to that sort of technology. And like I said before, there's going to be the Michael Jordans, and there's going to be the guys like me who are going to warm the bench, and, in that basketball game. But I think we're all getting access to the playing field in a much more equal manner now than we had been.
Right. I know there was a panel earlier this morning. The moderator, J.J. Kinahan, was stating repeatedly that it's really never been a better time to be a retail investor, simply for all of the tools that everybody has at their fingertips. And then Tony Zhang, who was also on the panel, was mentioning that his customers are asking to connect with the APIs, that they're basically using AI to create their own code and kind of wire everything in that way. That today's retail investor is so much more evolved than it was when you and I started.
Absolutely, and the costs have come down. I think one of the other panelists made the joke. He said,
"No inflation.
There's no inflation in this." Now, not everybody does it for free. Actually, within our firm, we offer a cost-based platform and a free platform, and actually, our customers widely prefer the cost-based platform because there's more price discovery and better, and they find the active trading customers find that they do better.
It's worth it. Yeah.
They do better by having us assist them with better executions. But that's still an advantage to them because we're offering them something. We're offering them a way to probe the markets in a way that years ago individuals couldn't do. Back in the floor trading days, how did you know where the market was? Someone would call down to your pit,
exactly.
And where's the market? And it's a quarter, 3 quarters, but maybe I think if you wanted to sell them, maybe this guy will bid me 3/8, that kind of thing. That this is all happening much quicker. The price intervals are much smaller.
Sure.
But this was something that information was kept among a more limited group. We've democratized that price discovery as well, and we do feel it's fair to pass along the costs of it costs us to do that. But from a point of view of the technology that's available to an individual investor, the price discovery that's available to an individual investor, the actual pricing everybody pay just exchange fees can vary by how much you trade and how much they get passed along and stuff. But essentially, there's really no disadvantage from a cost or, I'm not going to say there isn't a disadvantage on a technology basis, but the amount of technology that's available is immense. Obviously, if you've got some group of NASA scientists using a supercomputer, they have a technology advantage. But at what cost?
Yeah.
So I think the playing field has been substantially leveled in a very good way.
Agreed. And again, to reiterate, what JJ was saying earlier on the panel, it's never been a better time to be a retail.
I don't disagree. I do not disagree.
Steve, I really appreciate you taking the time. So good to see you again. Thanks for joining us.
My pleasure as always, Mark. Thank you. And so I love our chats.
Yeah,
so
I do too.
Keep them going.
I appreciate it. Thank you. We'll be talking to you again soon.
Thanks.
Thanks, everyone. That's going to do it for today. And stick around for more from the OIC conference. We'll be talking to you again soon. Thank you.